You are listening to CMQ Investing. I'm your host, Chris Franco. This summer, I built up the Instagram page, Warren Buffett Videos, and currently that has, I think it's close to 200,000 followers. But the reason I share this with you is because I love looking at what Warren Buffett wisdom about investing resonates the most. One of the most popular reels, according to the data, features Warren Buffett saying this: "I love it when the things we buy go down. If stocks are down today, I'm buying more of something I was buying yesterday and buying it cheaper." It sounds a lot like buying the dip, and that's what this episode is about. Now, I've talked about my own opinions about this sort of thinking in slogans that I noticed investors starting to do beginning around the time that the pandemic had wiped out most of the market, and then well into, I guess, pretty much right into this point now. The problem is historically speaking, or statistically speaking, 2022 has been the worst year for buying the dip since the 1930s. I'm going to read from a very popular and very new article that was published in the Wall Street Journal all about this topic. And the Wall Street Journal tends to do a really good job of showing sort of like the use cases of a variety of different types of investors. And I find that to be really useful, especially when coupled with all the data that they cite. So I won't try to sell it to you. I just know this was something I read and thought to myself, I think, our audience, that is you, will appreciate it as well. Before we get any further, just a friendly reminder to make sure you are following or subscribing to the podcast on Spotify or Apple Podcasts. If you already are doing that, thank you so much. I really appreciate it, and I will continue delivering new episodes for you every single week because that's what it takes, baby. That's what it takes to be number one. All right. So on that note, let's get to this article about the dip. It is the worst year for buying the stock market dip since the 1930s. Instead of rebounding after a tumble, stocks have continued to fall, burning investors who stepped in to buy shares on sale. The S&P 500 has dropped 1.2% on average this year, in the week after a one-day loss of at least 1%, according to Dow Jones market data. That is the biggest such decline since 1931. There's a couple other references in this, by the way, to the 1930s, so in some ways we can think of the times we're living in right now as quite literally, we're living through history. Like, they will look back at this being, like in this way. They'll say, that's the first time we've seen this since the 2020s. And only prior to that was in the 1930s. The extended downturn is putting a dent in the popular buy the dip trade. I've never heard it called buy the dip trade, but it's a strategy in which many investors have found great success after the last financial crisis, and particularly during the lightning fast pandemic recovery. Major stock indexes hit dozens of continuous records, convincing many investors that any downturn would be short-lived and an attractive opportunity to buy. Retail or non-professional investors have been enthusiastic dip buyers. Love it, buddy. Piling in even when institutional investors are coming out. That buying fervor has been an important counterweight for the market, and if it wavers, stocks could suffer even more. So please also hold the dip if you're buying it. The trade has backfired during the months-long downturn that has dragged the S&P 500 down 23% so far in 2022, on track for its biggest annual decline since 2008. The sell-off accelerated last week when central banks around the world increased interest rates, driving sharp swings across stock, bond, and currency markets. All three major U.S. stock indexes fell at least 4%, their fourth decline of at least 3% in 5 weeks. It's a tough stat to really digest there. Let me say that again just so we can laugh. All three major U.S. stock indexes have fell at least 4%, which is their fourth decline of at least 3% in 5 weeks. Many investors have been wrestling with high inflation, a continuing war in Europe, and the prospect of a recession. In the days ahead, fresh data on consumer spending and confidence will provide clues on how high prices are shaping Americans' behavior and the extent to which the Federal Reserve's interest rates increases are rippling through the economy. The volatility has been stomach-churning for many investors as they have watched their portfolios steadily decline in value week after week. "I've really been taking a beating," said Santi Taffarella, a 58-year-old community college professor in Lancaster, California. "I'm uncomfortable." Mr. Taffarella said he has been buying the dip in the stock market, including on Friday, only to see his positions quickly sour. Other investors said they are hanging on and haven't yet backed away from buying the dip, trying to keep a steady hand and an eye on long-term returns. At least one trend has persevered. Individual investors have tended to buy more shares of U.S. stock and exchange-traded funds on days when the S&P 500 is down than when it is rising, according to Vanda Research. That includes September 13, when the S&P 500 tumbled 4.3% in its sharpest one-day fall since 2020. Individual investors bought more than $2 billion of U.S. shares in ETFs that day, the second highest total of the year. They bought $395 million of the SPDR S&P 500 ETF Trust alone that day, the highest one-day amount of 2022. U.S. households have poured more money into U.S. equity mutual funds and ETFs than they have pulled out for the year. U.S. funds have drawn $89 billion of net inflows in 2022, according to EPFR Global data analyzed by Goldman Sachs. That is in contrast to many institutional investors who have yanked money from the market. Yet much of the euphoria that dominated markets in 2020 has evaporated. A basket of popular stocks among individual investors that includes Tesla, Amazon, and chip makers like AMD and Nvidia has fallen 30% this year, underperforming the broader market. Technology stocks are particularly sensitive to rising rates, leading to especially steep losses. Meanwhile, intraday trading among individuals, as defined by daily dollar volume, has dropped to levels not seen since before January 2020, before the pandemic. And that's also according to Vanda Research. Individual traders' activity in bullish call options, popular bets to profit from a surge in stocks, has tumbled to some of the lowest levels of the past 2 years, according to Deutsche Bank data. The frenzied, frothy behavior isn't there, but that long-term thesis of investing for the long term is. And this is according to the U.S. chief executive of brokerage eToro. Some of the momentum-driven trades that flourished over the past 2 years have caused big losses for investors. Attempting to buy the dip in Cathie Wood's ARK Innovation ETF, for example, has been particularly painful. On Wednesday, shares of the fund jumped as much as 3.2% as traders piled in, hoping to ride a rebound after a continued sell-off that has now dragged it down 60% this year. Instead, the fund ended the day down by roughly the same amount after the Fed's interest rate decision led many traders to rapidly change their forecasts for how aggressive the central bank would be in raising rates through next year. The rate increase stoked a sharp sell-off across the market. The ARK ETF drew $197 million of inflows Wednesday, the most for a single day since July, according to FactSet. The fund resumed its slide Thursday, falling 4.3% and heading toward a double-digit decline for the week. Caleb Adams, an 18-year-old university student who said he started investing a few years ago through a custodial account, a type of investment account for minors, said the ARK fund has been one of his biggest losers. I only wish he listened to CMQ because he would have hopefully avoided that. I fell into the trap of the high-growth, high-flying companies and invested money into our ETFs, and they have not done very well. Still, Mr. Adams, who started investing by buying into Tesla shares, said he has tried to continue stashing away money in his brokerage account regularly. Cash he received for his high school graduation helped him increase his exposure to the market, as did money he earned doing odd jobs for his parents, such as organizing business contacts electronically for his mom. Mr. Taffarella said his approach has changed dramatically since the depths of the COVID-19 pandemic, when he tried his hand at day trading with little success. Don't worry, Mr. Taffarella, most investors do not have success doing that, so you're not alone. He was hoping to make enough money to help pay for his daughter's college education and shield his family from the burden of student loans. I started off feeling very greedy, Mr. Taffarella said. I thought I can probably turn this into $100,000 within a year. They don't say what he was starting with, by the way, so I don't know what he thought he would turn into $100,000. Since then, he has shifted to a basket of diversified ETFs into which he has steadily poured money. One factor that is shifting the calculus for some investors: ultra-safe government debt is suddenly looking attractive. High inflation and the Fed's rate increases have stoked a sharp sell-off in the bond market, sending yields to the highest levels of the past decade. Claire DeWeert, a 34-year-old consultant and business owner based near Vancouver, British Columbia, said she bought a fund overseeing stocks and bonds earlier in the year to diversify her holdings, though the fund has fallen in value along with the broader market. She has also parked some cash in a fixed income investment for her business and has sought to build a bigger cash buffer in case of a recession. Still, she said she has no plans to sell her stocks. I think it'd be really silly to sell stocks, Ms. DeWeert said. I don't care what the markets are like in 1 or 2 years. I care what they're like in 30 years. So I like the way we finish that up there because that's a good reminder for all of us long-term investors. The question I try to ask myself is Is this year going to be a defining year, or is it just one of many years that will ultimately shape my average annualized returns over the investment time frame that I have? The answer is obviously for me the latter, and it should be for you too. And it's just a good reminder as to like, okay, yes, I'm down, let's say 20% this year, but what will my average annualized returns be over the next 30 years? I think one of the bigger points that the article is bringing to light is that many investors who probably correctly bought the dip, meaning they were buying something that was quality for less than what they initially paid for it, they may not have considered the psychology that's required to maintain this strategy, because you're going to have, in the short term anyway, bouts of extreme volatility. And if that's not something that you have ever experienced, or let's say you just got used to buying the dip and then things do go up shortly after that, well, this new sort of shift in this year, 2022, can be hard to cope with. And oftentimes I think investors can make big mistakes when psychological factors that they didn't anticipate start to come into play. Now, speaking of psychology, I plan to record some episodes that are specifically geared towards the psychology of investing. So make sure you stay tuned for those. There are plenty of other episodes that touch on some of these topics as well. So if you haven't had a chance to scroll through the library, I believe this is episode 118. So that means there are 117 other episodes that you can go back and listen to. And you should be able to find value in them because they were created to have enduring value, even when we focus on a current event, or in this case, a current article. So thank you so much for listening. For CMQ Investing, my name is Chris Franco. We'll talk soon. Later.